I use the retirement bucket strategy. Some people love it and some don't. Being a little bit of a worrier, this is the strategy that helps me to sleep at night. I get asked a lot of questions about the bucket strategy and how and when to refill your buckets. I set my buckets up before I retired. But I retired at 58 and a half and didn't want to touch my buckets until I was 59 and a half so I could avoid those early withdrawal penalties. So I set up a bridge account for this 1 year until I turned 59 and a half. But just for fun, I thought I'd show how I might have withdrawn money and rebalanced my buckets over the last year, considering how the market's done. So if I had been 59 and a half and I didn't have my bridge account, this is what I might have done. If you're seeing me for the first time, I retired in June 2024 with a little under $500,000 in my 3-bucket portfolio. Also, just a quick explanation of the bucket strategy in case this is new to any of you. I first read about the bucket strategy a few years ago on the Retirement Manifesto's website. The bucket strategy gives you retirement income but allows you to ride out market downturns so you don't have to sell investments at a loss. It separates your retirement funds into buckets. Each bucket has a purpose based on when you need the money. Bucket number 1 is short-term, no risk, and cash. I like to have 3 years worth of living expenses in bucket 1. Bucket 2 is mid-term or low risk. I like to have 6 to 7 years worth in bucket number 2. Bucket 3 is long-term and more risk. This is for year 10 and beyond. People argue that keeping 3 years worth of cash in bucket 1 is losing opportunities, and that is a little bit true. But cash doesn't mean it's not making any money. Currently, the money in my bucket number 1 is making around 4%. But the real value of the cash bucket is in case of a market downturn or emergency. When bucket number 1 drops below 3 years worth of cash, then I need to top it off or refill it. But if the market's down, I need to wait. If a market downturn lasts for several years and bucket number 1 actually runs out, it's possible you'll have to pull from bucket number 2. That's why it's not as aggressive as bucket number 3. If you have 3 years worth of living expenses in bucket number 1, it's pretty unlikely that that would happen, but it's not impossible. So after a down market, as soon as funds have recovered, that's when I'll rebalance and put money from buckets 2 and 3 back into bucket number 1. So when I retired in June 2024, I had $462,600 in my 3-bucket portfolio. So with my $800 a month pension and my YouTube income that's been around $700 a month, I need an additional around $1,000 a month for income. That's how much I've been pulling from my bridge account. My house is paid off, I have no debt, and I live frugally. So at the end of July 2024, my portfolio balance was $480,092. It was a good month in the stock market. My investments were up. So if I was pulling then, I would have pulled $1,000 probably from bucket 2, maybe my 401A or my 403B. I can just go online and request that a withdrawal be sent to my bank account. And that would have changed the balances to look like this. Then at the end of August 2024, here's my original portfolio balance. But if I had pulled $1,000 the month prior, it would look like this. And I realize it wouldn't be exactly $1,000 because of gains or losses, but it's just easier to figure out this way. August was a decent month in the stock market. My investments were up again, so I may have pulled that $1,000 from bucket 2 again, maybe this time my deferred compensation plan. That would have changed the balances to look like this. Then at the end of September 2024, here's what my original balance looked like. But if I had pulled $1,000 the 2 prior months, then it would have looked like this. September was another good month in the markets. My investments were up, so I would have pulled $1,000 from bucket 2 again, maybe this time from my 401A or my 403B again. That would have changed the balances to look like this. And you don't have to pull monthly. You can pull every 2, 4, or 6 months, or whatever works for you. It's whatever's easiest for you. This is just what I might have done. Monthly withdrawals have more potential for averaging out market fluctuations. But withdrawals once a quarter or once or twice a year might be a lot easier to manage. Then at the end of October 2024, my original bucket total looked like this. But if I had pulled $1,000 a month the prior 3 months, it would look like this. October was not a good month in the market. My investments were actually down a little bit, so I would not have pulled from bucket 2. I probably would have pulled from bucket 1 from my high yield savings account. That would have changed the balances to look like this. Then at the end of November 2024, here's what my original balances look like. But if I had pulled $1,000 a month for the prior 4 months, then it would look like this. November was a really good month in the stock market. My investments were back up, so I probably would have pulled from bucket 2. Maybe from my deferred compensation plan this time, and that would change the balances to look like this. Then at the end of December 2024, my original balances looked like this. But if I had pulled $1,000 a month for the prior 5 months, then it would look like this. December was not a good month in the markets. My investments were down just a little bit, so I would not have pulled from bucket 2. This time I would have pulled that $1,000 from bucket 1, probably my high yield savings account again. That would have changed the balances to look like this. Then at the end of January 2025, here's what my original balances look like. But if I had pulled that $1,000 a month for the prior 6 months, then it would look like this. January was a good month in the market. My investments were back up again, so I probably would have pulled that $1,000 from bucket 2 this month, maybe from my 401A or 403B again. That would have changed the balances to look like this. Then, at the end of February 2025, here's what the original balance looked like. But if I had pulled that $1,000 a month for the prior 7 months, then it would have looked like this. February was an okay month in the stock market. My balance was about the same as it was the month before, so I might not have pulled from bucket 2. I might have pulled from bucket 1 again. Probably my high yield savings, and then the balances would look like this. Then at the end of March 2025, here's what my original balances look like. But if I had pulled $1,000 a month for the prior 8 months, then it would look like this. March was a terrible month in the stock market. My balances dropped by over $5,000 from the month before. So I would definitely not be pulling from bucket 2 this month. I would pull from bucket number 1, probably my high yield savings again. That would have changed the balances to look like this. Then at the end of April 2025, here's what my original balances looked like. But if I had pulled $1,000 a month for the prior 9 months, then it would have looked like this. April was bad, not as bad as March though, but my investments dropped a little bit, so I would not have pulled from bucket 2 this month. Instead, I would have pulled from bucket 1, high yield savings again. That would have changed the balances to look like this. Then at the end of May 2025, here's what my original balances look like. But if I had pulled that $1,000 a month for the prior 10 months, then this is what they would look like. May was a great month in the markets. My investments were up quite a bit, so I would have pulled from bucket 2, maybe my 401A or 403B again. That would have changed the balances to look like this. So even after pulling $11,000 over that year, my investments would still be up 7.1%. Because May was such a good month in the market, this would be a great time to rebalance and top off my buckets. Normally, I would have rolled some money from bucket 3 over to bucket 2, but because my bucket 2 was a little heavier than I wanted it to be, and bucket 3 is a little lighter than it should be, I might not have done that. But since there were 5 months that I pulled $1,000 from bucket 1, I would want to roll some money from bucket 2 over to bucket 1 now. I could now pull $5,000 from bucket 2 and put it in my high yield savings account in bucket 1 to get it back up to 3 years worth. And I realize the math wouldn't have worked exactly like this, but this is just to give you an idea of what I might have done. There's no specific time that you need to top off your buckets. I would do it when the market's up, like I did in this scenario in May, but I could have done it in January when the markets were up too. You could do it every time the markets were up. It's whatever you feel comfortable with. I also didn't include June 2025 in this scenario because I was just looking at the first year. But the markets did really well in June, so I may have done some more rebalancing. Your bucket strategy can be personal to you. I have a playlist with all my videos I've made about the bucket strategy that I'll link below in case you're interested. Do you use the bucket strategy or some variation of it? I know some people use 2 buckets. If you want to share, feel free to leave a comment. If you're seeing me for the first time, hi, I'm Julie and this channel's Happy on Monday. Thanks for joining me. If you found this helpful, please like. And if you're interested in early retirement, consider subscribing. I'm going to leave you with the quote. Compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. Hope to see you again soon.